Good morning. Welcome to the Forex Pro Charts weekly analysis for the week of November the 7th, 2010. This week we're going to be looking at the Euro USD pair. As you know, every week we analyze 10 major pairs of currencies for our subscribers, and we take the analysis of one of those pairs and post it free to the public on our YouTube channel. It's also available free on our website. This week we're looking at the Euro USD, and we can see, looking at the monthly time period, that the Euro USD is currently moving up after falling almost to historic low levels. And it didn't fall quite down to here, but it fell down to here, and then it's moving back up. It's either a very significant retracement or a long-term price move all the way back up. We can see this last month, the month of November, that price has moved up beyond midway and is approaching the monthly armpit at the upper edge of our trading field. The edge of the trading field is denoted by the solid black line, which indicates the previous monthly highs. We also look and see that the overall 50 moving average is in an uptrend for the euro, although it has flattened out recently, and that's a result of these. As you know, this is a lagging indicator, so this is a result of this up and down kind of activity that we have seen that has caused the moving average to flatten out. But we are still considering it in an uptrend at this point. For swing traders who are looking to take longer term moves, of course, with our strategy, day traders can take either buys or sells depending if all the other conditions are correct. Okay, looking now at the weekly time chart, we're looking here and we see that this last week price moved out of this support zone all the way up to what was a resistance zone. It spiked through, and then it has moved back down before the week closed. If you remember back previously, we were looking at this doji and seeing that we had hit this resistance zone and looking at the doji as a sign of price reversal. We did see some reversal back down to this support zone, but not a long-term reversal, and now we see price moving back up again. Now it will remain to be seen whether or not price continues back up, whether it's able to overcome the intersection of the extended trend walls and move into the area bounded by the monthly armpit and the solid edge of our playing field, which would be where we would expect to see a long-term price reversal. But for now, we're looking at price moving up in this area and looking to see what will happen there. Now, if we're looking at upcoming potential zones, we see that this zone is most likely dead. In fact, it is dead, and we'll look at it on the daily chart. We'll not be trading this zone again, and that's because price spiked up and through, indicating that the limits of this zone were no longer valid. If price moves back down to this support zone, day traders will be able to trade the 60-minute and 5-minute armpits. We'll look at those in more detail. Swing traders probably will not want to trade this. As you can see on the weekly chart, there is no rally-based drop or drop-based rally pattern. This is simply a zone that we have just put on the chart. It's part of a larger trend, and even if price reverses, it will not reverse at this zone, causing that pattern. Also, currently for a buy, this zone overall is not a 3-to-1 reward to risk ratio. Now, if price on this last candle continues up, moves to this zone, then we will see a 3-to-1 ratio. But at this point, we do not have that. So this zone is only good for day traders. Now, if we move back, if price drops all the way back down to this zone, which is quite an extensive drop, and we certainly don't expect to see that this week unless we have very unusual circumstances, at this support zone, we do see the drop-based rally pattern, and we also see that obviously there is much more than a 3-to-1 reward to risk ratio. In other words, looking at the origination of the zone and then where price ended up before it reversed, even if price reverses at this point, obviously we have much more than a 3-to-1 ratio here. So this will be a good zone for a trade. We will notice that this is part of a stacked zone. However, the upper zone in in this case is probably stronger because that is where we do have the drop base rally pattern. Day traders will be able to trade both trades. If swing traders will need to make a decision, and that should be one factor that they use in making their decision as to which of these zones to trade. Now, if we're looking at if price moves up and goes to a resistance zone, we can see that we have two zones up here before we reach the upper edge of our playing field, and both of these actually qualify as stronger zones that swing traders may be willing to take a trade on, and of course day traders can trade as well. Looking at this first zone here, we see that even though this is part of an overall longer downtrend, we did see a little bit of a rally-based drop pattern, and that is strengthened by the fact that we are right below this this monthly armpit here, which we usually see a bounce. So while in the long run we would expect to see price move up into this area between the monthly armpit and the edge of the trading field, we should be able to see a nice bounce and a good number of pips off of this zone, and swing traders may want to trade there. Again, this is against the zone, so swing traders will want, against the trend, so swing traders will want to be a little bit cautious. Now, when price moves to this zone, that is a even better zone for swing traders because we have a high likelihood that price will reverse because it's at the upper edge of our trading field, and of course we have this very strong rally-based drop pattern with the very good risk to reward or reward to risk ratios. You'll notice in this zone we do not have a 60-minute armpit. It's a fairly small zone. We'll look at it in a little bit more depth when we're more likely to get to it. Okay, now here we're looking at the daily time chart, and we're looking a little bit more detail at the upcoming zones and where we might take our trades. And first, let's look and see at this zone that began at 1.4134. We saw that price moved up. We'll look at the price action within the zone on the hourly chart to see if we were able to achieve our bounce and our pips. But overall, on the daily chart, we do see that price moved up out of this zone, went well beyond the left behind targets, and then turned and reversed back down. This zone is no longer tradable. It is not valid, and if price continues down, we'll be getting rid of this zone and probably forming a new one here. So if price does continue down, which it looks from this pattern like it will here, if you look at traditional technical analysis, you see that we have the sell setup on the daily chart, which is indicated by these three candles that form the rooftop pattern both on the outer and inner portions. And that's a more traditional technical analysis signal, but when combined with this zone here, we would expect to see price continue down. So it will continue down to this support zone, or if it continues down to this support zone. We don't take the bounce off of the daily armpits unless we're very aggressive traders. But we've seen more often than with the 60-minute armpit that trade is not successful, although it does still have a decent percentage there. And we do have some traders who like to trade that. However, we'll be looking in this case, we would not recommend taking that trade because we don't have the 3-to-1 reward to risk ratio. So even our more aggressive traders should not be taking the trade off of the daily armpit. Now, when we get down to the 60-minute armpit at 1.3743, it looks like you see that we have much smaller risk here. And this should present a nice area for day traders to be able to take the bounce and capture their profits after the first 20 or so pips, and then leave remaining portions of their trade in, moving their stop to break even as price reverses and continues up. That way, if it does not reverse all the way and moves back down, as it did here, you will not be in a loss position, but you'll be in a break-even position on those trades. We also have a 5-minute armpit on this zone, which again, some of our more aggressive day traders like to trade the 5-minute armpit. It's a very low risk, although it is not quite as high a probability trade as the 60-minute armpit. Now, should price continue reverse here and continue back up, then we could be slowed. We don't like, again, we don't like to trade the daily armpits, and we could be slowed by these intersecting trend walls and seeing price move up to the 60-minute armpit at 1.4530. However, at that point, day traders should be able to trade the bounce, although they may want, although they may want to account for this a monthly armpit. When placing their stop, it is possible that price would spike through this zone up towards the monthly armpit since they are so close. So if you're a day trader taking this trade for the bounce, we should generally see a stronger bounce when we have a weekly or a monthly armpit in connection with our zone. But this is 100 pips above our 60-minute armpit, and traders need to be sure that they're comfortable with that degree of risk before placing their trade and placing their stop. Now, looking back on the hourly chart, we would like to examine the price action for the week to see what happened. And we can see here, this was a news event. I'm not sure which one it was in particular, but it was a news event. And you can see that price spiked rapidly up. It hit the daily armpit and the 60-minute armpit, and then took its bounce, moved back up beyond the daily armpit, and back up to the 60-minute armpit for the second time. Then it moved up here. However, with this candle, we received an excellent bounce because price spiked way up, spiked way down, and we received a bounce off the 60-minute armpit of over 150 pips. Even our conservative traders should have been able to capture 100 pips of that by closing out their first portion of their trade when they reached the 20 or 25 pip limit, whatever they had installed, and then on the second and third portion of their trade, again with the limits or managing that trade actively, should have been able to capture at least 100 pips. Now, this price action was fairly quick because it was a news event. You can see that it all occurred within the hour, and then price moved back up. It did hit the daily armpit and kind of bounce again, but then when it moved here, it moved all the way back up through and then back down. So even though it looked like price moved up through the zone, we do see that price did bounce off the 60-minute armpit and bounced quite nicely, and we were able to achieve a good number of pips on this particular trade. That concludes our analysis of the Euro USD for the week of November 7th. For more information or to subscribe to our full analysis and charting services, which includes analysis of 10 major pairs of currencies. It also includes trade alerts during the week when we're approaching the 60-minute armpits. And it can include, depending on the subscription level you choose, free downloads, our charting services, and then free downloads of the prepared charts every week to save you the time in preparing your charts. You can go to our website, www.forexprocharts.com. Thanks very much for joining us, and we look forward to seeing you next week.